Financial accounting is the most important aspect of the business. This report is a comprehensive review of the financial and accounting function of the business. Accounting and finance has been the major contributor in managing the operations of the business efficiently. These functions help the managers in making an informed decision related to the future by looking at the past trend. In part 1, I will talk about slide 3 and 4. The first part of our report is the financial reporting environment in Australia. We are going to discuss some basic elements of the financial reporting standard in Australia. The authorities in Australia are mainly focusing on developing the investor confidence and the integrity of the companies in Australia. All of the business in Australia are required that they ensure that the business activity in Australia is up to the par, and this is why they are required to make the business activity statement and make sure that they make their tax payments accordingly. The companies in the country are required to ensure that they prepare the financial report according to the Securities and Investment Commission of Australia. The accounting standards in Australia are set by a board which is known as Australia Accounting Standard Board, which is also known as AASB. This institution is an independent government institution which make decisions independently. All of the corporations in Australia are required to go by this standard. The AASB also goes in accordance with the International Accounting Standard Board. There are some decisions that are made independently that suit the environment of Australia more, and they are made taking into consideration of matters of the country. Now we will move to slide 5 and 6. Accounting is an integral part of any country. Without it, there is no guarantee of success, and it is highly likely that the company isn't going to be able to manage their affairs. Accounting helps the company in managing their affairs by summarizing, analyzing, reporting their current and past transactions. These transactions help the company in great deal as they are there for the investor, customer, employees, and the top level management of the company. They are going to use this information in order to better manage the company and make the future predictions in the right manner. The accounting process is extremely important to understand as well. There are 8 integral steps in the process. The first step is to identify transactions. The next step is to record transactions in a journal. The third step is to post their transaction in the general ledger. And the fourth step is to have a trial balance, which is going to be unadjusted. Analyzing the worksheet is going to be the fifth step of the accounting cycle. The next step is to adjust the journal entries. After the company adjusts the journal entries, they generate its financial statements. The last step in the accounting cycle is to close the book to show it to the users of financial statement. Part 3 is about slides 7 and 8. The main purpose of the conceptual framework is to assist the IASB, the developing the future standard, and the implementing and reviewing the current ones. It can also assist the preparation of those financial statements in the development of the accounting policies of the company or any government body. The main objective of the financial reporting is to track, analyze, and report the income of the company. This report analyzed the performance of the company in relation with the competitors and other elements. This in return helped the company and investors in making the informed decision. If the company doesn't do the proper reporting, then it's going to cost them a lot, as it is going to hurt the image of the company. Furthermore, it is important to understand that the impact of this financial statement at some level, it gives the company and the upper level management indications as to where the company is going. Now we will move to slide 9 and 10. As we all know, there are 4 main financial statements of the company are considered to be the 4 main pillars of the finance of the company. The first main financial statement is balance sheet. In the balance sheet, there are assets, liabilities, and equity of the company. The assets and liabilities are further divided into current and non-current. The next main financial statement is the income statement. In the income statement, there are 2 main sections. One of the revenue section, where all the accounts related with revenue are associated, and then there is an expense section after we have dedicated all the expense from the revenue. The next profit of the company is generated. The next financial statement is the cash flow statement. There are 3 main parts of the cash flow statement. The first part is cash flow related to the operations of the company. Then there is cash flow related to the investment activities, and then there is cash flow related to the financing activity. The next statement we have is the changes in the equity of the company. The statement of the changes in equity also has various parts. In this, there are retained earnings, dividends, and net income of the company. About slide 11 and 12, the first concept in the financial reporting is the accounting equation. The accounting equation looks something like this: assets equal liability plus equity. The double entry principle states that for every debit, there is always going to be the credit. And in the double entry, there are always going to be 2 accounts involved. An account in accounting refers to either assets, liability, equity, expense, and income of the company. The credit rule says that the account that would contain a credit will increase when credit is added to the specific account. The debit rule is the opposite. And the charge of accounts means the list of the account that have been identified in the reporting of the company. Next, I will show you the some charts about effect of transaction, general journal, ledger account, and trial balance, and I will add it into the slide as well. Thank you for listening.